Everybody wants to talk about Treasury futures, and I can't blame them. With the Treasury yield inverting, it's the story of the day, or maybe even the week, and eventually maybe even the year. That's yet to be determined. But obviously when the yield curve inverts, people start to get a little bit worried because it is known as being a precursor to a recession. It could be a year down the road, could be 2 years down the road. We don't know. And that's assuming that this inversion is similar to what we've seen in the past. There are some definite questions as to whether or not that's going to hold water in this particular case, because we're talking about global quantitative easing and all kinds of other weird things that could be interfering with the theory of the yield curve inversion. So first, let's talk about why the yield curve is inverting. We've seen the 10-year note yield drop from 3.25% in roughly early November down to 2.35% as of earlier this week. That's a crazy drop in a short amount of time. We're talking about almost a full percentage point. This isn't extremely shocking to us. All of last year we kept reminding our followers of the idea that basically everybody was short Treasuries. I hate to say everybody because obviously that's not true. But the reality is if you look at the COT report, which is issued by the CFTC, the Commodity Futures Trading Commission, last year, right about the time that Treasuries topped out, we were seeing that large speculators who are supposedly the smart money, they have deeper pockets, they're holding big positions, those speculators were the shortest they have ever been in the history of Treasury futures. They were massively bearish, and unfortunately for many of them, that's exactly when the market turned around and started heading the other way. And the reality is, when everybody's short, the market often runs out of sellers because all of the selling has already taken place, and now those people that are short the market have to buy back their futures to get out. So what we've seen in the last several months is everybody that was short last year has been unwinding that position, and it's forcing the market up. And as the market goes up, yields go down, and the yield curve is inverted. So if you look at a COT report now, you'll notice that speculators have gone from being really short to basically neutral. So that position's been unwind. The question here is, where do they go going forward? I'm not necessarily going to bet the farm on anything that I say today, but with that said, you can't assume that although in the last several months traders have been buying to get out of positions, going forward they're going to be buying or selling to play out their fundamental or technical analysis. So it's going to be based on analysis and opinions, not necessarily a need to get out of the market. And so that does change the dynamic of things. If you look at a weekly chart of the 10-year note futures contract, you'll see that while we've come a long way in a short period of time, it's not entirely impossible for us to go a little bit higher. If you followed any of our research from last year, late last year, we did look for the market to forge a rally, and it has. It hasn't been quite as dramatic as we thought it might be. We thought we would potentially see 128 on the run, but now that we're here and we've seen the shorts unwind themselves, we're kind of questioning whether there's a lot of upside potential at all from here. In fact, we think maybe the market could be getting a little bit toppy. So if you look at a weekly chart, which is what we've got up in front of you, you'll notice that the RSI, the Relative Strength Index, as well as Williams percent R, are both showing the market's a little overbought. That doesn't necessarily guarantee that we're going to reverse from here, obviously, but it's just one piece to the puzzle. We also see several resistance areas that are coming in as trend lines and those sorts of things. So there's kind of a confluence of resistance here that could put a lot of pressure on prices, or at least prevent it from going a whole lot higher. That said, if there's some sort of surprise, maybe failure with the Chinese trade deal, maybe some sort of miraculous change of heart with the Fed, and we've seen that already in the last several months, so it's not impossible to see the Fed change stance. But if something unexpected happens, I wouldn't be shocked to see the market press up, run some stops, maybe see 126 in the 10-year note, maybe even 128 if something gets really crazy. I'm not counting on that, but we do think that if you're planning on playing the downside in the 10-year note, you should leave some room for error. Make sure you're hedged. Make sure you have some sort of protection that protects you if we do get a spike to 126 and on the off chance 128. However, the more likely scenario that we are looking for is some softness coming in the next couple of weeks. We think regular digestive back and fill would put us around 120 in the 10-year note, and we wouldn't be surprised to see the market dribble down to 116. If the economic data recovers, things start to look a little more rosy in the economy, 116 could definitely be in the cards by mid to late, actually I'm going to say mid-2019, so in the next handful of months. By the way, we are DeCarly Trading. We're a futures and options brokerage service in Las Vegas, Nevada. If you're interested in trading futures and options, please visit our website, decarlytrading.com. There is plenty of educational material, articles, videos, an opportunity to buy our books. But to be honest, the books, I should say, plural, are cheapest on Amazon. The book we recommend primarily is Higher Probability Commodities Trading. This is a little more advanced. If you're a beginner, look for a trader's first book on commodities. If you're comfortable with the basics, a Higher Probability Commodity Trading might be a good point. If you have any questions or if there's anything we can do for you, let us know.